All right, guys, welcome back to this week's episode of the Dream 80 of a farm that I purchased with my wife in Iowa. This week we're going to talk about potential issues that you have to look for and what a closing of a real estate transaction looks like with a bank or a contract for deed. So last week we talked about the financing and the numbers of the property, other ways that we could afford the down payment, other ways that we could afford the actual payment from our job or from income the property was producing, talked about refinancing and equity pulls and or timber harvests and opportunities that you can have within the land to make it feasible to pay for itself, or at least part of itself. This week we're going to talk about the actual closing of the property, the mortgage recording, and some other notes that I have along the way. So with this property, it was accessed by an easement. Since I'm a real estate broker in the state, I recognize this. As a buyer that would not have this information, you would really want to deal with a real estate agent that knows their stuff inland, because this property would have been a major closing hiccup in the event I hadn't figured this out in advance. So the property did not touch a road. It was very secluded, which was one of the things that drew me to the property, because I didn't want to have a road up against the property at all. When I was younger, I always looked at properties and thought it would be the coolest place to be able to go back and hunt or be somewhere where no one else could honk when they drove by on the road, or I was in some secluded spot that was really special and exclusive to me and myself and my family. So that's one thing that's really important to my intentions that I identified, as I wanted it to be very excluded. The problem with that not touching a road was that it had a very short easement going into the property. Well, that easement, there used to be a home on the property, a building, and that easement had never been recorded. The neighbor either owned this property, or the neighbor was fine with somebody driving across his land, but or the road moved or whatever it may have been. But somehow in the history of the property, there was not legal access recorded to the property. So a bank is going to have a problem with giving you a mortgage on the property and giving you 75% of the property's value and giving you that money in the event there's not legal access to the property, because it could greatly diminish the opportunity to sell that property for fair market value in the future if you can't get to it. So on this property, there was a access driveway that had been there for a very long time. I went to the neighbor and introduced myself. You want to be very non-threatening. You know, you're new in the neighborhood and they don't know you, and they've lived there for many, many years. These were absolutely wonderful neighbors, great people. Introduced myself, told them that I was purchasing the property right next door. Told them, that I intended on going down the driveway access to the property. However, the attorney and the county do not have it identified as an easement. Now, that driveway had been there for decades and being used for a very long time. So the attorney did tell me that if we wanted to force the issue, we probably could do that because they'd been using that driveway as a driveway for many, many decades. So it was obvious that it had been there and being used by that property to service as the access. I didn't want to force anything, to force my hand, and thought the better way to go about it was be kind and introduce myself and just ask the neighbors if they would be willing to sign an easement. In this case, I think it's very important as a buyer that it's going to benefit your property. The way I felt about it is that I should pay for the survey and the recording of that easement and the attorney drafting of that easement, since it was benefiting me and my property. Not coming in and knocking on a neighbor's door and saying, here's what I'm going to do, how I'm going to do it, and that I expect you to pay for it. I just don't feel that's the right way to be. So it worked out in my favor. They were willing to sign an easement and have that notarized. It got recorded at the county. The bank saw that was recorded at the county as a legal access to the property, and were very okay with giving me a mortgage to the property. Seeing what the value of that was. The bank would order an appraisal to make sure that property is going to appraise. Since there's other sales that had sold for substantially more money in the area, that appraisal was no problem at all, and there was actually built-in equity right off the bat. But a bank is usually going to use the lower of the two, appraised price or purchase price. So in this case, even though there was sales much higher, they used the lower of the two, which have been the purchase price, to establish the 25-75 LTV ratio to come up with my payment. All right, so a very important thing that I want to talk about is what closing looks like. It can be very daunting to think about buying a piece of land, going through the bank loan process, the closing process, the relationship with the real estate agents, the neighbors, all that. So after I got done with the easement being recorded at the county so the property had legal access, we were scheduled to close on the property. Now, when you get ready for closing, you have to look at a settlement statement, and a settlement statement is going to be provided usually by the real estate company or the attorney that's handling your side of the closing, depending on what state or a title company that you're doing the closing in. And then there's going to be closing costs on there. Some of those closing costs are going to include prorated property taxes, so you're paying your portion of the property taxes moving forward from closing and beyond into the future, and the seller is paying property taxes into the past. Depending on the state and the attorney or title company or real estate company, you might get a check at closing for those property taxes, and it's very important to make sure you know that that money is for the future property taxes. The seller is paying them on the entire settlement statement for the period that they were to pay them for. However, you might get a check at closing for the prorated property taxes. Just realize that you need to use that for the property taxes and that you are responsible for those property taxes moving forward. The check that you have is for paying the entire property tax amount, of which you're going to be responsible for your portion. The check is for the seller's portion, since they're only paid to the county once or twice a year. So saving that money and adding to that money for the future payment of those property taxes is an important item when you get the money at closing, in the event you do. And then you also want to put on your calendar when property taxes are due on the property to make sure they don't go delinquent, just in case the county does not update the taxpayer address of the property on the parcel on the county records. So you want to make sure the property taxes are paid in full for obvious reasons. So you're going to have prorated property taxes, potentially prepaid insurance for 6 months or a year. The bank is going to want to make sure you have insurance on the property, so you don't go out to the property right after closing and have some incident that's going to create some kind of a liability on the property that the bank just gave you 75% of the purchase price. Technically, their asset is your land and the mortgage that you have to pay them on that property. Well, if there's a liability on the property or you default, the bank is going to want to make sure that liability is covered by insurance. So make sure you get the property insured on or before the date of closing to make sure that doesn't hold your closing up as well. But an expense, prepaid insurance. Other things that come up on settlement statement are going to be recording fees, real estate fees, attorney fees for doing your closing. Just make sure to review that settlement statement with the attorney, the title company, or the real estate agent to make sure that you know what those line items are and to make sure they're accurate and correct. A good real estate agent will always review those settlement statements in advance to make sure all the fees are accurate. You have to think about the person that drafted that settlement statement might be doing 5 or 10 closings a day, and if you don't have some second set of eyes, they might have accidentally put a fee on there or miscalculated a fee, and if it gets missed, it can get recorded and paid for incorrectly. You want to make sure your real estate agent knows what they're doing with land transactions and understands that every single line item is money at the end of the day that the buyer or seller are going to pay or get credited or debited. So very important piece of the closing puzzle. When you go to a closing, you're usually going to go to a title company, a law firm, or a real estate firm. There's going to be somebody there to walk you through those expenses. Make sure you ask questions about the settlement statement, about the easements, about other things that were information about the contract that you had, prorated CRP, prorated tillable rent. Make sure you view the property in advance to make sure there weren't any trees cut down, buildings removed, fires that happened, anything that changed, if it was including tree stands or box blinds or furniture or things that were on the property as part of the transaction. Always just check so there's not any type of changes that you're not aware of before closing on the property and parting ways with your money or your loan. And then realize that you have different options for how to title the property. So in advance, you could decide to title the property personally and have your own Schedule F for the income on the property, or just to title it personally in you or your spouse or your partner's name, or put it into some type of business, like an LLC is a very common one. A limited liability company is going to limit the liability that happens on that property, as well as potentially give you some tax benefits for items to be on the property, used for the property, used as a write-off for that property, or as a piece of equipment that's purchased for that property. And a lot of those pieces of equipment for that business, for that real estate owned by that business, may be able to be a tax benefit to the income that's created or generated on that property. So great questions for your accountant in advance, great questions for your attorney, your real estate agent, your title company in advance of closing, to see what opportunities this land that you've already decided to buy for other reasons of hunting or personal investment that might give you some tax advantages, or tax opportunities in the future with this financial investment that you're about to put into land. That's what I have on the topic of how we finance the Dream 80. If you like what we're producing here in the Dream 80 series, please like and comment and subscribe to our channel so we know we're doing a good job, and thanks again for following along.